Hello everyone, it's Wednesday, November 19. Today we will analyze the charts of the euro and the British pound to assess potential market movements. Yesterday saw limited activity with volatility remaining low at around 20 pips. The market was range-bound, although the euro attempted to decline during US trading hours, weighing down by US initial job claims for October. The US dollar also received some support from positive data regarding the US housing market and factory orders, although these reports did not provide the greenback with a significant advantage. In addition, officials from both the Federal Reserve and the Bank of England spoke yesterday. Fed policymakers emphasized the need to keep interest rates steady, raising questions about the possibility of a rate cut in December. Much will depend on the upcoming data to be released later this week. As a result, the market remains cautious, lacking a clear direction in anticipation of significant statistics. Similarly, the British pound traded sideways throughout the previous day. Turning to today's macroeconomic calendar, we see a batch of important news releases on the agenda. The day begins with UK consumer price data, where inflation is estimated to have risen by 0.4% month-on-month in October, after a flat reading in September. On a yearly basis, UK inflation is forecast to have decreased to 3.6% in October, down from 3.8% over the previous 3 months. If the data confirms cooling inflation, the Bank of England may consider cutting interest rates by the end of the year. These expectations are currently limiting the pound's upside potential. The UK is also set to release data on input and output producer prices. It is likely that today's statistics will prompt the British pound to break out of the sideways range and has been trapped in for nearly a week. Regarding Eurozone data, the calendar includes information on the current account as well as inflation figures. The final consumer price index for the Eurozone is anticipated to show a reading of 2.1% for October. If this figure is revised downward, especially with core prices below the estimated 2.4%, the European Central Bank may decide to maintain its current policy stance, which is unlikely to support the euro. Speaking of US statistics, traders may take notice of trade balance data and the minutes from the Fed's latest monetary policy meeting. As you know, the US Central Bank has lowered interest rates, but expectations regarding its future policy direction have shifted swiftly. Therefore, today's minutes will be especially significant, as they may provide clues about the Fed's future path, potentially backing the dollar. After all, the Fed's rate-cutting cycle appears to be on hold for now. Now let's move on to technical analysis. The 1-hour EUR/USD chart suggests that a rise followed by a false breakout at 16.07 would trigger a sell signal, dragging the euro down to 1.1584. A break below this level could propel the euro down to 15.64, potentially opening the path toward 15.43. At this level, I would recommend considering long positions on a rebound, targeting an intraday correction of 15-20 pips. Long positions at 15.64 could be initiated on a false breakout. Supported by positive data from the euro area, consolidation above 15.84 could lead to a rally up to 16.07. If the price breaks above this upper boundary of the sideways range, the euro could surge to 1.1632 with the potential to extend gains to 16.55. At this level, it would make sense to open short positions on a rebound, targeting a move of 20-25 pips. Going short at 16.32 and 16.07 would only be appropriate following a false breakout. As for the British currency, the market situation is similar. Sell entries could be considered at the upper boundary of the sideways range at 31.76, particularly on the false breakout. A rise to these levels is possible following the UK's inflation data release. Alternatively, if sterling reacts negatively to the news and declines, a return below 31.38 would increase pressure on the pound-dollar pair, paving the way for a drop to 31.11 and potentially to 1.3086. At the 30.86 level, it would be prudent to consider long positions on a rebound, aiming for a 20-25 pip move. Long positions at 31.11 and 31.38 could be opened in the event of a false breakout, with the target set at 31.76. If selling activity remains subdued in this area, sterling could extend its bullish run to 32.11 and possibly even reach 32.44. At this level, I would recommend going short on the rebound, targeting an intraday correction of 25-30 pips. Short positions at 32.11 and 31.76 should only be considered on a false breakout. Best of luck to everyone.